If you've ever wondered what Forex trading really is, how people actually make money from it, and whether it is real or just another online scam, then this video is for you. In the next 45 to 60 minutes, I'm going to break down Forex trading in the simplest way possible. No hype, no fake lifestyle, and no complicated grammar. Just the truth. By the end of this video, you will understand how Forex works, how traders make money, what moves the market, the mistakes beginners make, and exactly how you can start properly in 2026. This might be the most important financial video you watch this year. What's going on, everyone? My name is Sam Keys, founder of Freedom Tradehouse. I'm a Forex trader, educator, and mentor. And for over 6 years, I have helped thousands of people understand how the market truly works. No hype, but from real education. In this video, I'm going to explain Forex from the absolute zero. So even if you've never heard the word PIP before, you understand everything I'm going to teach. I'll cover what Forex really is, how money is made, how prices move, what brokers do, what leverage is, how beginners should start, and how to avoid blowing your account. So if you're serious about learning a high income skill in 2026, this video is for you. Before we begin, make sure you like this video, subscribe to the channel, and turn on notification because I drop real Forex education here every week. Let's start with the most basic question. What is Forex? Forex simply means foreign exchange. Forex is the global marketplace where currencies are exchanged. Every time you change Naira to dollars, dollars to pounds, or euros to yen, you are participating in Forex. That's it. That's all Forex is. It's not magic, it's not a scam, and it's definitely not gambling if done properly. It's simply the exchange of one currency to another. Now, let me give you an example. If you travel from Nigeria to the United States, you will change your Naira to dollars. If you travel from United Kingdom to Japan, you will change pounds to yen. That process of exchanging currencies is what Forex is built on. Now, Forex traders don't travel around exchanging money physically. We do it digitally, and we speculate on the value of one currency against another. Why Forex exists? Forex exists because countries trade with each other. Nigeria buys goods from China, America buys oil, Europe buys machinery. So currencies must be exchanged. This constant exchange is what creates opportunities for traders. Key facts about Forex. Let me give you some important facts about Forex. Forex trading is the largest financial market in the world with over $7 trillion traded daily. Open 24 hours a day and 5 days a week, it is the largest decentralized financial market. Now let's talk about how Forex trading actually works. In Forex, you are not buying or selling money physically, you are speculating. You are predicting whether a currency will go up or down in value. Forex is traded in pairs. And why is that? That's because you can't measure one currency alone. You must compare it to another. Examples are EURUSD, USD JPY, XAUUSD, that is gold. So when you see EURUSD, it means euro versus dollar. If you believe the euro will become stronger than the dollar, you buy EURUSD. If you believe the euro will become weaker than the dollar, you sell EURUSD. That is it. You're not buying physical euros and you're not selling physical dollars. You are trading price movements. How money is made. Let's make this very simple. If you buy at a low price and sell at a higher price, you make money. If you sell at a high price and buy back at a lower price, you make money. That's how traders make money. Example, let's say EURUSD is at 1.000 and you believe it will rise. So you buy. It goes to 1.1050, you close the trade. That way you made money. If it goes down instead, you lose. Forex is a game of probabilities, not certainty. Who moves the market? A lot of beginners think Forex is moved by retail traders. That is false. You and I do not move the market. The market is moved by big players, and these include banks, hedge funds, governments, corporations, central banks. These institutions trade billions of dollars daily, and we retail traders simply follow their footprints. Know this important truth. If you want to survive in Forex, you must stop thinking like a gambler and start thinking like a professional. Professionals follow money, they don't guess. Now that you understand what Forex is and who moves the market, let's talk about something very important, and that is, how does price actually move? A lot of beginners think price moves randomly. That is not true. Price moves because of supply and demand. A simple explanation is if more people want to buy something than sell it, price goes up. And if more people want to sell something than buy it, price goes down. That's it. The same rule applies in Forex trading. Imagine this. Fuel scarcity happens in your city. Everyone needs fuel. There is little supply. What happens? The price goes up. Now imagine too much fuel and nobody is buying. What happens? The price goes down. Forex works exactly like that. Now let's learn about why demand changes. Demand changes because of interest rates, inflation, economic news, war, government decision, employment data, and bank policies. When the US raises interest rates, the dollar becomes more attractive. When a country is unstable, investors move their money out. Important lesson: price does not move because of indicators. Price moves because of money. Indicators only help you understand what already happened. Now let's talk about what these symbols mean. These are candlesticks, and there are 4 important information you must know about a particular candlestick. The candlestick shows you the session open, the session close, the session high, and session low. So let's represent that on the screen. Talk about, let's say this is a candlestick. Let's see this quickly. The candlestick comes up with a high here, and then we have another one at the bottom here. So let's give this the blue color. So take a look at this. If the candles open at this bottom and then closes above its open price, we'll call it a bullish candle. However, if the candle opens at the top here, let's say it opens from up here and closes at the bottom, the open was up and closes at the bottom, in this case we'll call it what? A bearish candle. So we'll call it bearish. Now, the high and the low of candlesticks are the same in both bearish and also bullish candles. What does that mean? It simply means the highest price that price got to during that session. Let's say, for example, as we're talking about the bearish candle, price opened here. And after it opened, it went up first and reached this particular high price, then came back down and started going downwards and goes to the very bottom here before it returns and closes at this particular point. So this level, which is called wick, what we have at the top there, it is called a wick. We have wicks at the top and also have wicks at the bottom. These wicks, let me just type it in on the screen so you can see. The wick shows areas where price has been rejected. Now, the top of the wick right here is called the high, and the bottom of the wick right here is called the low. So we can just call this low. Then at the top, we can call it high. And since we're talking about a bearish candlestick, this point here becomes the open because it opens at the top and then it closes at the bottom. So we'll have this as our close and we have this as the open. So this is how candlesticks look. So in my chart, you can see that the black candles are the bear candles. Let me just make it look exactly like that. The black candles are the bear candles, simply meaning that they open at the top and they close at the bottom. However, the blue candles on my chart are the bullish candle. They open at the bottom like this one and closes at the top. And you can actually set any color for your candlesticks. Some people like using green candles for bullish candlesticks and red candles for bearish candlesticks. You can do that and choose your preferred colors anytime you want after this video. So now let's talk about why candlesticks matter. Candlesticks show strength of buyers, strength of sellers, rejection, indecision, and momentum. Price action is simply reading this story. In other words, price action is all about understanding the strength of buyers, the strength of sellers, the levels where price was rejected, or the areas where we have indecision, and also the areas of the chart where the momentum of the market increased. This is an important beginner advice. As a beginner, don't memorize fancy candlesticks. Focus on strong moves, rejections, breakouts, and ranges, basic Forex terms. Now, let's explain some words you will keep hearing. What is PIP? A pip is the smallest movement in price. If EURUSD moves from 1.1000 to 1.1001, that is a pip. Pips are the units we use for measuring profit and loss. Now, what is a lot? A lot is the size of your trade. It's simply the amount of money you're willing to risk or to make in a particular trade setup. There are 4 types of lots. However, for the beginner level, we will talk about just 3. There are the standard lot, mini lot, and the micro lot. A standard lot represents big money and a micro lot represents small money. Examples of standard lots are 1.00, which equates 0.10. Example of mini lot is 0.10, which represents $1 per pip. And an example of micro lot is 0.01, which represents 10 cents per pip. Why does lot size matter? If you use a big lot, you make more, but you also lose more. This is why risk management is everything. What is spread? Spread is the difference between the buy price and sell price. It's how brokers actually make money. Think of it as a little fee. Example, if EURUSD buy is 1.1002 and sell is 1.1000, the spread is 2 pips. How brokers really work? A broker is a middleman. They simply give you access to the financial markets, and without a broker, you cannot trade Forex. In a nutshell, a broker stands as intermediary between you, the trader, and the financial markets. A broker executes your trades, provides leverage, gives you a platform, and holds your money. They make money from spread, commission, and swaps. They are businesses, not charities. Please remember that brokers are businesses, not charities. There are some important brokers. Some brokers are market makers, ECN, or STP. As a beginner, you don't want to stress so much about this. Just use a regulated broker. And if you're looking for a broker to trade with, I recommend you trade with the broker that I trade with. Check the link in the description of this video to sign up now. Now, take note of this important warning concerning brokers. Never trade with an unregulated broker. If they disappear, your money disappears. So if you want to avoid falling victim for scam brokers like this, I recommend that you trade with a broker that I trade with. Now, let's talk about one of the most misunderstood things in Forex: leverage. Leverage is simply borrowed money. It allows you to control a bigger trade with a small amount of money. A simple explanation: if you have $100 and your broker gives you 1:100 leverage, you can control $10,000. And if you have $1,000 and your broker gives you a leverage of 1:100, that allows you to control $100,000. That does not mean the money is yours. It means the broker is allowing you to trade a larger position as if you had that particular amount of money. Without leverage, most people would not be able to trade Forex because currencies move in small amounts. Leverage helps amplify those movements. Here's the problem: leverage does not only multiply profits, it also multiplies losses. This is why beginners blow their account. Not because Forex is fake, but because they misuse leverage. Important line: leverage is a tool, not free money. Pause for answer. Leverage is a tool, not free money. What is margin? Margin is the amount of money your broker holds to keep your trades open. Think of it as a security deposit. If your losses reach a certain level, the broker closes your trade automatically. This is called a margin call or stop out. Margins matter because they protect the broker and not you. This is why you must always protect yourself with stop losses. Now let me show you how all this looks like on the real chart. The symbols you see on the screen are candlestick. Here we have the bullish candlestick, like I explained at the beginning of this video, and we have the bearish candlestick at the top. Now, horizontal levels of the chart where you see price get to and the reject are called support or resistance. So let's take that for example. Here you can see there's a particular point price got to here. We can use a tool like a horizontal ray, and then you place it right here. By the way, I am doing this analysis on TradingView, so you can visit tradingview.com to have access to the chart like this. So now I placed this line right here. This line represents a top, and that top is called resistance. So when price rejects or reverses from the top, that level where it reverses from is considered as a resistance. However, at this particular point, you can see the resistance got broken and price pumped all the way to the top side. Now, if you look very closely, you will see price was rejecting at this particular bottom. You can see price got to this top, dropped down here, and continued going up. This level at the bottom where price rejected is what we call support. So support and resistance are important concepts that you as a beginner trader must know. Now, let's look at another concept that you should also know. When price is moving diagonally, let's say when price is, for example, as you can see, the market is moving from the bottom all the way to the top, we can actually identify some diagonal support or diagonal resistance. When it is moving from bottom to top, what we try to identify is the diagonal support, and we can do that using something called a trend line. So let me just identify that trend line. So this trend line connects several lows of the uptrending market. So we have a low here, another low here, another low at this particular point. So those data points are what I connected for us to be able to establish this trend line, as you all can see right now. Let me take it to put this all the way through to here. Good. In a downtrending market, the reverse is the case. In a downtrended market, you connect the highs of the candlestick to identify diagonal resistance. And as you can see in this case, I connected this high, this particular high up here. I connected it to the high here at this point. And if you look at it very well, you see that price broke out of it around this particular level, and it created a new low, like a floor at the bottom there, and it took it up from that particular point. So price literally broke out of the trend line, came here and created a support. Support can be considered as the floor and resistance as the ceiling. So it took support here. There was some level of resistance at this point. That is why you see price rejecting up here. But finally, price broke out of it and tested it again for support. You can see after it breaks, it comes back to test and goes to another level of resistance, and so on and so forth. Now, how do people actually make money, trading this market? Let's say, for example, price gets into this particular level at the bottom here, and if you trace it to the past, you would see that this particular area was formerly some kind of support area from here to here. So I'm just going to make that lighter. Let's put it. You see that this area was formerly some area where price rejected. So now, as a trader, if you get an opportunity, you buy at this bottom because price came to this low and you're expecting it to go up. You buy at the bottom, you place your stop loss below a zone like this where price rejected before, and then you put your take profit. So because we had this place as a support turning to resistance or so on, or let's go backwards. Let's imagine all of these have not happened before. So we'll definitely want to put our take profit here because this was previously a support. So I can put up a line and place it here because this is support here and the resistance at this particular point. Then I can set another take profit at this top here. So we can just get a rectangular tool, put it, we can just get a horizontal ray and we'll place it here. So I can set my take profit at this particular level. So now when you execute trade setups like this, your risk is the stop loss, your take profit is your profit, and then you could have multiple take profit like take profit 1 or take profit 2. Now, when you have trade setups like this, your risk is your stop loss and your reward is your take profit. Important lesson: trading is not about predicting, it's about reacting. Now, how do traders really make money? Most beginners think traders make money by guessing, gambling, or using magic indicators. That is false. Real trading is about risk management, probability, discipline, psychology, and consistency. For example, if your strategy wins 60% of the time, you will lose 40% of the time. Losses are normal. What matters is, do your wins outweigh your losses? Professional mindset. Traders don't aim to win every trade. They aim to be profitable over time. I repeat, Professional traders don't aim to win every time. They aim to be profitable over time. This line is so important. Forex is not a get-rich-quick scheme. It is a get-rich-slowly and consistently business. I repeat, Forex is not a get-rich-quick scheme. It is a get-rich-slowly and consistently business. Now let's talk about the various types of traders. There are 4 different types of traders: scalpers, day traders, swing traders, and position traders. Scalpers trade for minutes. Day traders trade for hours, but open and close their setups within the same trading day. Swing traders hold their positions overnight, and position traders hold their position for weeks and months. Now, take note of this. As a beginner trader, you'll be wondering, what is the best trading style for me? I need you to know that there is no best trading style. There's only what fits your lifestyle. So you may want to try out starting from the scalper level down to the position and figure out what actually fits you the most. Now, let's talk about why most people fail in Forex. Now, people fail in Forex not because the market is fake or because trading doesn't work. They fail because they make the same mistakes over and over and over again. Let me show you some of them. Mistake number 1, overtrading. Many beginners think the more trades they take, the more money they make. That's false. Professional traders wait. They don't chase. They wait for the best trade setups to come to them. Mistake number 2, no risk management. Some people risk 50% of their account on one trade. That's gambling. One bad trade should never be able to destroy you. So you want to keep your risk low from 1% to 5% per trade until you are comfortable to take mid-risk like 5% to 10%. Mistake number 3, no stop loss. If you don't know where you exit a losing trade, you're not trading, you're hoping. So you definitely want to know exactly where you're going to exit your trade setup in case it doesn't go your way. Hope is not a strategy. I repeat, hope is not a strategy. Mistake number 4, revenge trading. Revenge trading happens when you lose one trade and then you get angry and then you enter again without thinking. This is how accounts die. That is literally how accounts die. It's just like digging a hole and thinking that the more you dig, that is how you're going to get out. No, it doesn't work that way. Mistake number 5, following signal groups blindly. If you don't understand why a trade is taken, you're not a trader, you are a passenger. And passengers don't control the destination. So as a trader, you want to ensure you have enough knowledge before you start taking trade signals of signal providers so that you'll be able to make more informed decisions about your money. Mistake number 6, unrealistic expectations. Many people think $100 to $10,000 in 1 week can actually happen. That is not trading, but that is fantasy. Because if you check the statistics of people who can actually achieve that, we're most likely going to be having 0.01% of situations where that happen. So instead of fantasizing, you want to focus on what you can do logically. Now let's talk about how to start Forex trading properly this year. This is a roadmap I wish somebody gave me when I started about 6 to 7 years ago. Step 1, learn the basics. You must understand what Forex is, how price moves, risk management, and psychology. If you skip this, you will definitely suffer. Step 2, demo account. Don't rush into real money. Spend as much time as you need to understand the assets that you're going to be trading and also the trading platform on your demo account. Practice with fake money. Treat it like real money. And that is what even makes the difference. Some people, they perform very well in fake money, they come to real money and they start misperforming. They perform less in real money. That is because while they were performing on the demo trading, they were like, okay, this is virtual money. I can have limitless amount of it. So the thing there is you need to practice like it is real money. Imagine that you've been given that money to trade. How are you going to manage it? Step 3, choose a strategy. A strategy is simply a rule-based way to trade, not vibes, not emotions. Rules and rules. You follow the rules, you get the result. Step 4, learn risk management. This is more important than strategy. You can be wrong and still make money, but you can be right and still blow your account. So it's all about risk management, knowing the amount of money you're going to be risking per trade and the amount of money you're going to be risking per day, or the amount of money you're going to risk per week. This allows you to create a longer lifespan for your money when you're trading. Step 5, journal every trade. Write down why you entered the trade, why you exited, and the lessons that you learned from that particular trade setup. This is how professionals grow. Step 6, start small. You can start with as little as $50 or $100 or $200 or $250. Don't rush it. Start with an amount of money that you can afford to deposit over and over and over again. Don't start forex trading with your lifelong savings. Start with small amount of money that you can truly afford. And always remember, the goal is skill, not excitement. Step 7, scale slowly. When you become consistent, you increase, not before. You don't increase before you become consistent. You first of all become consistent before you increase the amount of money that you are trading with. For those who have been trading for a while and they're actually having this as a challenge, I think you really want to go back to start trading small amounts of money and focus on your consistency rather than how much profit you are about to make in a single trade. How much money you really need. Now, this is a very important topic. One of the most asked questions is, how much money do I need to start Forex? Sometimes I post that on Twitter. You want to click the description of this video to see link to follow me on Twitter. I used to ask, how much money do you need to start Forex trading in 2026, or 2027, or 2028, in whatever year? And you get to see a lot of responses. Now, let's find out from this video how much money you really need to start trading Forex. The truth, you can start with small money, but you must have realistic expectations. For example, if you have $100, you will not make $10,000 in 1 month, but you can build the skill. Skill first, money later. I say it again, skill first, money later. How long does it take to become profitable? Here is another honest truth. Most profitable traders took 1 to 3 years to get consistent. Not 1 week and not 1 month. Now, this is why it takes time. It takes time to master psychology, it takes time to master discipline, and it takes time to master patience. These things are not downloaded, they are developed. So next time you think about how long you need before you become very profitable, so you want to focus on how fast you can develop your psychology, your patience, and also your discipline. Now let's talk about the truth about Forex. The truth about Forex is not easy. If it were easy, everyone would be rich. Forex will test your patience, your discipline, your emotions, and your ego. But if you respect it, it can change your life. Now, it's important to note that Forex does not make people rich. Forex reveals who you already are. If you've watched this video up to now, I respect you because most people want shortcuts, but you have chosen to get understanding. Remember, Forex is not a lottery. It is a business. And if you treat it like a business, it will pay you like a business. This channel, Freedom Tradehouse, exists to give you real Forex education and not hype. If you've learned something today, like this video, subscribe to the channel, and join my Telegram community with the link in the description of this video. Also, if you're ready to go all the way up, learn Forex trading the proper way in 2026, put in the comments, I am ready. And also let me know where you watch this video from. Thank you for watching. My name is Sam Keys Forex, and I'm always here to help. See you on my next video.